Greetings. My name is Gino Mapetere, and this is a recording on leases, the tax treatment of leases for the purposes of ICA's IAC examinations. Our learning outcomes for this session is first, the understanding of the fundamentals of lease transactions, examples of the different kinds of leases and their details, understanding the task or problems that you may be required to solve in an examination, and then the approach on how to solve those tax problems, be the income tax, value-added tax, or capital gains tax. Let's start with understanding the fundamentals of lease transactions and some of the examples. So with leases, you can have a lease in which, fundamentally in a lease arrangement, the one taxpayer there or party to the lease is granting the right of use of an asset to another, and in return, ordinarily you get a set of payments. So this can be lease rentals. The payments can be lease rentals or lease payments. You use an asset for this period and you pay me so much. Lease premiums, there's an additional amount there being paid over and above the lease rentals for some advantage that is being gained over and above that location. Yes, it is the lease of a building for a store, but then of late there's been so much footfall in the area in which the building is located, and then the landlord then asks for a premium on those lease rentals because of that advantage of more customers coming through. Improvements can also happen under a lease. That's a contract. That's a transaction that you would then need to be dealing with. Right. So that's fundamentally how the lease operates. It's granting of a right of an asset, and in return there are quite a number of things that can happen: payments, improvements, and premiums. There could be a lease, but with a view to transfer ownership, which is a rent to buy arrangement. So you're renting, but we are calculating the total rentals for a certain period, and in the end, the cumulative payments that have happened may also then result in transfer of ownership. Or you can have a sale and lease back, where to raise finance, an owner of an asset may decide to sell that asset, but they still need to use that asset for their trade, and then they start leasing that asset from the person that they've sold the asset to. Again, we're trying to say, so what will happen in terms of the tax treatment, be it income tax, be it VAT, be it CGT. So there's so many other leases that can be consummated, and again, you would need first to understand the details of the lease in front of you in the examination for you to then be able to solve the problem that you are being asked to in the exam. So let's understand the required. As with most of the recordings in this series, first you have to look at the wording in the required. So there's different types of required. So this time I'm not going to be going through each word and what it means, but I've just highlighted some of the key components. What are you being asked to do? There's a verb there, discuss. So you know you're going to be stating the principles, you know you'll be applying the principles, and you know you'll be concluding. That earns you marks. Tax implications can mean all three taxes, which is income tax, VAT, CGT, or you could be asked to discuss only the income tax, only the VAT, or two in combination. The taxpayer can be either the lessee or the lessor, or you can be asked to discuss in both. And then there's a year of assessment. All these things help you to scope your solution. Another type of required is slightly different from number one, is where you're being asked to calculate and income tax, payable or refundable. So here you're just not looking at the gross income or the tax, you're looking at the tax payable. So you're actually going to calculate the tax itself. So there's different types of calculate type questions. You can just be asked to calculate the taxable income, which is different from the tax payable or refundable. And then it's from the lease transaction and in the hands of the lessee in this case. So can you see there's various ways in which the examiner can ask about the same transactions, and it is important for you to first understand what you've been asked. Here we're trying to drill you into running away from memorizing solutions from past exam papers, because the required can be varied, and that will significantly change what your answer will look like, even for the same transaction. Here's another one. It's a tax planning one, which says advise one of the taxpayers on whether the taxpayer should sell and lease back or rent, considering the better VAT outcome. So here you're being asked to deal with the VAT in a sell and lease back and VAT in a rent to buy arrangement, and then compare the two VATs and recommend. So that's tax planning. Very, very important for you to have an open mind as you get into this exam, that there will be various angles in which you can be examined the same type of transaction. So when you practice, beware. Do not then get too comfortable with the solution for a particular question that you have done and feel that is the only angle or approach, and you memorize a solution hoping that once you're asked to deal with the lease problem, you can go and fetch that solution that you once did and then try and plug it in and force it to fit to the new challenge that you would have been given. So let's look at solving an income tax type problem. With an income tax type problem where there's a lease, first is to check what the lease payments are about. And there, if you are the lessee, you are looking at, as you pay these lease payments for the right to use the asset, is it for the purposes of trade? Because if it is not, then you cannot get a deduction. I'm thinking as well, you have to read in the scenario whether this lease had been incurred already or it has not yet been incurred, that lease expense. Again, you need to really look at the factors in the scenario for you to decide which tax principle under allowable deductions on lease payments are you looking at. Some scenarios can end up having you to consider whether to capitalize those lease payments or not to capitalize. Right. In the hands of the lessor, the owner of the asset, or the person leasing out the asset, there's a gross income story, and you have to look at quite a number of factors, but again, it is determined by what is in the scenario. For example, in the lease, there could be a barter arrangement where someone is leasing out a building, and in exchange, the lessee is paying them through cattle feed. So that's barter exchange, and the amount becomes an issue. In some cases, they're just renting, and the amount is $7,000 per month. So there's nothing to really discuss under amount. So you need to approach lease payments from a lessor's perspective by looking at gross income. But the next set of payments is the premium, where there is an excess. Here, you're no longer using the general deduction formula or the gross income formula. For the premium, when you're looking at the lessor's perspective, you have to use Section 81D, that then says the premium is included in gross income at the earlier of the receipt or accrual. But where it is a prepayment that has been made by a customer, you would then obviously have to include in gross income the premium that is attributable to the tax year concerned. In the hands of the lessee, you're still looking at, is it for the purpose of trade fundamentally, but you also now have a specific provision that provides further clarity, which is section 15.2D. And section 15.2D is about how you treat a lease premium. So gross income, the general rule, the gross income rules apply: earlier of receipt or accrual. You could have an amount issue. You could be looking at source. But at the end of the day, what is very important there is to recognize that a premium is included in gross income. Section 8.3 still applies if the premium has been prepaid, and we need to match it to the period in which the premium relates. That is when we'll put it into gross income. But for the lease allowance, you have to complement the general deduction formula with section 15.2D, which then spreads this lease premium over the lesser of 10 years or the lease life. That 10 years excludes the extension options. Sometimes when the lease contract does not state, the lease is deemed to be over 10 years. In some cases, the asset that is being leased is being used for both trade and non-trade. Yes. So then in that case, there's apportionment between purposes of trade, the extent in which it is used for the purpose of trade. Continuing with the income tax problem on lease improvements. With lease improvements, for both the lessor and the lessee, there's a specific provision that then complements the general provisions. For the lessee, in terms of the deduction of improvements, the section 15.2E applies to improvements on land or buildings only. These could be obligatory, where the contract stipulates an amount that someone can improve those assets. And if not stipulated, the commissioner can then determine a reasonable amount. Once the amount has been determined, there is an option to either claim capital allowances or to claim a lease allowance. In this case, you go for a lease allowance, and that lease allowance is spread over the lesser of the lease period or 10 years, commencing date of first use of those improvements for purposes of trade. Again, an apportionment is allowed where the asset is used for trade and non-trade. Voluntary leases will not qualify for a lease allowance, but there will be capital allowances allowed for that. Let us look at the VAT on leases. So here, there's so many different types of leases that can be constructed, type of transactions. And for VAT purposes, one would then need to ask first, what is the supply? We need to understand. This is not the solution plan, but just to say. So here, not for the purpose of coming up with a solution, but for your understanding, for your approach. In a lease transaction, is there any supply there? Yes. Someone is being given a service, which is the right to use an asset. And it is for the furtherance of trade. So you'll only have VAT if it is for trade purposes. And in the process, there's a lease payment that is being paid in exchange for that supply. And in some cases, a premium for that supply. Again, the supply on the premium is that additional advantage. And the supply on the lease improvement is the actual improvements. So for instance, if it's a building, someone then improves it by putting a helipad where a helicopter can land. The construction of the helipad is the supply, which are goods really in that case. So yes, so at the back of your mind, yes, this is a transaction that has a supply and in furtherance of trade. You would then need to look at the classification. So the classification will depend on each and every type of lease supply, the service or the goods. And you would have to say, are these goods or services rare rated, exempt, or standard rated? In terms of the payment or the premium or the lease improvement. So it's a case-by-case assessment that you will have to make. When it comes to the time of supply, it is going to depend Where you have a continuous supply in the form of rentals, where a person makes payments as they use an asset, that is called a successive supply, and the time of supply is when the payment is either due or is received, whichever comes first. So if I'm renting a building and I'm paying my rentals, if I pay my rentals in advance, that is the time of supply. Or if they become due and I pay in arrears when they first became due, that becomes my time of supply. But you could also have a lease that is then classified as an installment credit agreement, and we would need in the next slide to look at what an installment credit agreement is. Once a lease has been classified as an installment credit agreement, the time of supply becomes the time of delivery of that supply or any payment. So we need to know what an installment credit agreement is, and we'll look at it very soon. So when it comes to premiums and improvements, you're not looking at an installment credit agreement in that arrangement. The value of supply for leases, again, specifically for an installment credit agreement, it's about the consideration in money for the supply, and it shall be deemed to be the cash value of that supply. So for example, in a rental, when you are in a rental arrangement, which is not an installment credit agreement, you'll be looking at just those payments. So for instance, I go and rent out a television from TV Sales and Home, and they say pay $30 a month for the next three years, or 36 months, or 30 months. That will come to $900 or so. Or in an installment credit agreement, they say come pay a deposit of 25%. The cash value of this television is $800. Pay 25, which is a quarter, and then you pay 200. You take the TV home and then pay so many installments, and within there's in the payment there's a principal repayment amount and the finance common component, and so on and so on. When that is the case, as opposed to the $30 value of supply in the successive supply in our earlier example, now you will have to say, what is the consideration in money for the television? And it is the cash value of that television. The cash value in this case is 800. But when you look at the rest of the payments, the cumulative payments will end up maybe at 1,200 over the time that these payments will be made. Right. So again, we're not looking at the premium and improvement when it comes to installment credit agreements. What is an installment credit agreement? It arises either in a sale or in a lease, right? For goods consisting of movable or machinery, whether the machinery is movable or immovable. So here, supply under sale, we're not worried about it because we are dealing with leases. But when it's a supply under lease, there's got to be 4 key characteristics. One, there's got to be rental payments, which happen periodically or even at the end in a bullet payment. There's got to be a finance charge, whether it's spread or paid once in that bullet. There's got to be the cash price the total of the lease payments at the end of the lease must exceed the cash value. And the risk is now borne by the lessee. If something goes wrong with the asset, even the insurance, it's with the lessee during the life of that lease. Yeah, now, so moving on to capital gains. With capital gains tax, the question is there disposal of a specified asset? And when you're leasing and you're not disposing of any specified asset, either the lessor or the lessee, there's no CGT. But for your examinations, just look out for possible transfer of ownership on some of the assets at the end of the lease to see if there's no form of transfer and possible disposal of specified asset, which then will create CGT. You should also consider that the asset being leased, whether the asset is a specified asset in the first place. Because some assets, such as movables, are not specified assets anyway. So you're not going to be worried about CGT. Thank you very much. Asante sana.